Hello, traders. Welcome back to another episode of the comprehensive course on options trading. Until now, we have studied various crucial aspects of options. We started right from the basic elements of option, such as defining what an option is, the two types of options, moneyness of an option, profit and loss profiles, etc. Now, in this episode, we shall study how to read some main elements of an option chain. I guess you have a basic idea of what an option chain is. As of now, you might know about spot price, expiry, strike prices placed at the center of an option chain. You might even have an idea about call options, which are found on the left side of the strikes, while put options are found on the right side of the strikes. You might have knowledge about premiums or last traded prices of these call and put options. And you might even have a fair understanding on how to classify these strikes as ATM, OTM, and ITM. But an option chain is much more than all these. So, in this video, I'm about to tell you the proper method of reading an option chain using three vital tools. These tools are bid ask spread, volumes, and open interest. As we did in the previous episodes, we will use the option chain available on the NSE website as our reference. Now, if this series of videos are helping you improve, kindly support our initiative by liking, sharing, and commenting on this video. Also, make sure to subscribe and enable the bell icon to never miss out on any new updates. So, without wasting any time, let's get started. Have you ever wondered why strike prices in an option chain are limited? Why can't the strike prices go to zero or till infinity? Some of you might say it's because of space constraints, and you're right to some extent. But it is not the correct explanation. The real reason is liquidity. Beyond a certain strike price, the liquidity ceases to exist. This implies two interconnected things. First, the participation of market participants is very low. Second, the premiums are unattractive. That is, either the premiums are too high or they are too low. Therefore, one can say unattractive premiums may be the reason for lower participation, or it is due to the lack of interest that the premiums are behaving differently. So, when trading an option, it is important to ensure that there is enough liquidity among the option contracts that you want to trade. Trading an option or any other asset that is not liquid is very risky because of various factors such as choppy price movements, high transaction cost, difficulty in entering and exiting trades at the desired price and time, etc. Anyways, what really matters is the liquidity. So, as a trader, how can you identify if there is enough liquidity available or not? This is where liquidity indicators in the option chain come to the rescue. There are three main liquidity indicators available. These are bid ask spread, volumes, and open interest, or OI for short. Let us now see what these variables represent and why is it so crucial to understand them as well as to monitor them when entering an option trade and after having entered an option trade. We will begin with the bid ask spread. If you look at an option chain, you won't explicitly find bid ask spread. Instead, what you get is the bid and ask prices and the bid and ask quantities for both calls and puts. Let's not worry about this right now. By definition, bid ask spread is the difference between how much it cost to buy an option and how much I would receive from selling an option. The ask price is the price the market is willing to sell the option to me for, and the bid price is the price the market is willing to buy the option from me for. In other words, the bid price represents the highest price someone is willing to pay for an option, and the ask price is the lowest price someone is willing to sell an option for. The difference between bid and ask is called as bid ask spread. So basically, bid and ask are market terms representing supply and demand for an asset. Now, the bid size or bid quantity represents the quantity of security that investors are willing to purchase at a specific bid price. Ask quantity represents the total quantity of securities that the sellers in that particular strike are willing to sell for at a specific ask price. In case of options, the bid and ask quantities are provided in lot sizes. So, in short, the bid and ask data helps you to visualize available prices and quantities for a particular strike. But how does this help in identifying the liquidity position of an option? This is where the width of the bid ask spread comes into play. The bid ask spread can be narrow or wide depending on the market participation. Narrower the bid ask spread, the higher is the liquidity, making it easier to execute trade closer to the market premiums. Likewise, the wider the spread, the lower the liquidity, making it difficult to execute trades closer to the market premiums. Let us consider an example using a Nifty 50 option to understand this. Let's consider the Nifty 50 call option with the strike price of 24,700. The bid price is 67.60 and the ask price is 67.70 rupees. Here, the bid ask spread is 0.10 rupees. This can be considered as a narrow spread because the difference between the bid price and the ask price is very tight. Now consider another strike price, say 25,350 PE. The bid price of this strike is 659.35 rupees, while the ask price is rupees 672.60. The spread in this case would be 13.25 rupees. This is a very wide bid ask spread. This wider spread can affect an investor's decision in several ways. So if you purchase this put option at the ask price of 672.60 rupees and then you decide to sell it immediately, then you would likely have to sell at the bid price of 659.35 rupees, thereby incurring a loss equal to the spread amount. This represents an immediate cost. This can also be a nightmare for those traders looking to execute large orders, as a significant portion of the order can affect the bid ask prices, potentially widening the spread and increasing the cost of the trade. For instance, if the trader purchases 100 lots for the ask price and sells it immediately at the bid price, then the net loss would be 100 times the spread. Not only this, a narrow bid ask spread is often associated with better price discovery, which is simply the process by which the market determines the price of a security. A narrow or tight spread mean that the bid and ask prices are closer, suggesting that the agreed upon price reflects true market values more accurately. The Nifty 24,700 call option had a market premium of 67.70 rupees, which falls in the range of its bid and ask prices. On the contrary, wide spreads can indicate uncertainty or lower confidence in the current price levels, possibly leading to inefficiencies in the price discovery process. The Nifty 25,300 put option had a market premium of 633.45 rupees, which is way out of the line with the bid and ask prices. So always keep in mind that a narrower spread typically indicates a more liquid market, making it easier to enter and exit positions without a substantial price concession. Another observation that you can make is that as you move towards the deeper ITM strikes, the spread widens. The difference in bid and ask prices here are very big. This indicates lack of any activity or liquidity. So try to stay away from these deep in the money strikes. Now, if you move towards the deeper OTM strikes, we can see a reduction in the bid ask spread and an increase in the participation, thereby suggesting high liquidity. But as we have discussed in the previous episodes, the probability of these deep OTM options expiring with any real value is very low. So again, try to stay away from buying deep out of the money strikes as well. Now, let us understand the other two liquidity indicators, namely volume and open interest. Volume and open interest are two different concepts, yet they are very closely related to each other. You must already be familiar with what volume is with respect to stocks. But here, we will talk about volumes with respect to options. Basically, volume refers to the total number of contracts that are created over the course of the day. For instance, a volume of 100 represents 100 contracts have been traded on a particular option during a day. Keep in mind that in the option segment, for every buyer, there is a seller. In the case of this example, a volume of 100 means that there were 100 transactions between buyers and sellers, and all this accounted for a total volume of 100 contracts. Now, as you may already know from my price action course, volume by itself does not reveal anything, especially when trying to confirm the price action. Just take the case of the previous example. A volume of 100 for this option would say nothing. As a trader, you will instead have to compare this figure either with the past volume data or with the historical average or even with other option contracts for that matter. This would give you an idea of whether the volume on a particular option contract at a particular point in time is strong or weak. For instance, continuing with the same example, if the other nearby strikes of the same underlying with the same expiry and option type have volumes of 500 or even 1000, then it can be said that volume of 100 for this particular option is relatively low. Hence, an important thing to keep in mind is that volume should never be looked at in isolation. It is not a standalone metric. Once you have visually determined that an option contract has decent volumes and hence is tradable, you can then use volumes to validate trading signals. Let me explain. Generally, higher the volume, the greater is the trading interest or participation in the option contract and vice versa. In technical analysis, it is often said that volume confirms the trend. It is one of the important principles of Dow theory. For context, an up move in the option price that is accompanied by an increase in volume is often considered as a bullish signal because it indicates an increase in the buying interest. On the other hand, an up move in the option price that is not accompanied by an increase in volume must be treated with caution because it indicates that there is not enough buying pressure, which could soon cause the rally to exhaust. Based on this idea that price and volumes go hand in hand, I have listed out some general guidelines related to volume and price of an option. Using this table, you can identify different trading signals that are generated due to different combination of price and volumes and their likely outcome in the option prices. For example, if the option prices are falling but the volumes are rising, then it is considered as a bearish signal as it indicates an increase in the selling interest. On the other hand, a down move in the option prices along with declining volumes indicate a decrease in the selling interest or that the downtrend is losing its steam. Now, let's look at the most important liquidity metric in an option chain, the open interest. Listen carefully. Open interest refers to the total number of option contracts that have been created but have not been closed out yet. In other words, it refers to the total number of open option positions till date. For instance, an open interest of 500 means that there are 500 option contracts that have been created but they are yet to be closed out. However, unlike volume, which is applicable to both cash and derivative segments, open interest is applicable to only the derivative segment. But just like volume, open interest also tells a lot about the prevailing liquidity in an option contract. Basically, high open interest indicates ample liquidity, while low open interest indicates lack of ample liquidity. Therefore, as an informed trader, you should preferably open positions only in those option contracts that have good open interest. Now that we have a basic idea about OI, let's dig a little deeper to learn how to interpret open interest. Before we start, always keep in mind that in the option segment, for every buyer, there is a seller. So if one party is buying, say 50 option contracts, then on the opposite side, there are sellers who are selling 50 option contracts. Now coming back to our discussion, at any point in time, open interest could change or remain the same depending upon the type of transaction. For example, if both sides to the transaction, that is long and short transactions, are old or new, then open interest will change. Else, the open interest will remain unchanged. I know you are confused, so let's clear this up. I have listed out these relationships in a small table. As you can see from the table, if a buyer and a seller are both opening a new position, then the open interest increases by one contract. On the other hand, if a buyer and a seller are both closing out their existing positions, then the open interest reduces by one contract. Meanwhile, if only one party to the trade, be it either the buyer or the seller, is establishing a new position, while the counterparty to that trade is closing out an existing position, then the open interest remain unchanged. We will take an example to understand this concept better. Let's say the market opened with an open interest of 50,000 contracts. During the day, trader A opens a new long position by buying 500 contracts, while trader B opens a new short position by selling 500 contracts. At the end of the trading day, the open interest increases by 500 contracts as both A and B are opening new positions totaling to 50,500 contracts. Now, on the next day, the market opens with an open interest of 50,500 contracts. During the day, trader A decides to close his 500 contracts by selling them. Now, trader C, who is an existing holder of a short position, buys 500 contracts to close her position. So, at the end of the day, the open interest decreases by 500 contracts as both A and C are closing their existing position, thereby totaling to 50,000 contracts. Now, on the third day, the open interest remains at 50,000 contracts. And during the day, trader D, who is an existing long position holder, decides to sell 300 contracts. And a new trader E buys these 300 contracts to open a new long position. Now, at the end of the day, open interest remains unchanged at 50,000 contracts because one trader closed their existing position while another trader opened a new one. I hope you get the idea now. Just like volumes, looking at open interest by itself does not give you a clear picture. Instead, you must always compare open interest with price to understand the strength of the move. In this table, I have highlighted the relation between price and open interest. Now, you can make generalizations like how we did in the case of price and volume relationship. So, if an up move is accompanied by an increase in open interest, then it indicates new positions are being created which could support the price rally, and it is a bullish signal. Meanwhile, if an up move is associated with a decrease in open interest, then it could indicate weakness and an end to the price rally. I have used the term short covering here, which I will get to in a short while. Anyways, if a price decline is supported by a rise in the OI, it indicates creation of new short positions which could support the downward price move. It is a bearish signal. And finally, if there is a price decline and the OI is also decreasing, then it could indicate a halt in the down move. Here also, I have used a term called long unwinding, which we will take a look at shortly. In brief, open interest that confirms the price action is usually supportive of the price move, and it indicates that the current trend is healthy and it is likely to continue. On the other hand, open interest that does not confirm the price action indicates that the current trend is getting weaker and it could soon run out of steam. By now, you may have a basic idea about most of the elements of an option chain, especially the open interest. So let us move to the meaty part of this video. In this section, we will discuss how to read, interpret, and analyze an option chain properly. Being able to do this is very crucial when trading options because it lets you understand the structure of the underlying in terms of its option positioning. It enables a trader to know at what level an underlying could find support or resistance, as well as gauge what would happen once a key support or resistance is convincingly broken. The shifting of open interest and volume structure also informs a trader about the prevailing trend of the underlying in terms of whether the trend is strengthening or weakening. So let us learn how to read and analyze an option chain. This is the Nifty option chain for contracts expiring on 29th August 2024. As you can observe that most of the volume and open interest activity tend to occur around options that are closer to at the money. The further the options are being ATM, the lower the volumes and the open interest tend to get. Also, options that are very deep in the money or very deep out of the money have much lesser volume and open interest compared to options that are closer to the at the money strikes. Meanwhile, it is also worth mentioning that most of the volume and open interest activity tend to take place at strikes that are round numbers. For instance, Compare the volume and OI activity for strikes such as 25,000 and 25,100 versus those strikes such as 25,050 and 25,150. It can be clearly seen that the activity at the round numbered strike tends to be significantly higher than the activity at the odd numbered strikes. So, when opening an option position, keep a note on all these points to ensure that both volume and open interest are good enough, or in simple terms, there is ample liquidity to support entering a trade position. Volume and open interest tell a lot about the market sentiment in terms of the positioning of buyers and, more importantly, that of the sellers. Notice how I use the word importantly before sellers. The reason why I have used this is because option writing or selling not only requires more margin, but it is also much more riskier. We have talked about the risk reward profile of a writer in the previous episodes. Hence, option writing is usually thought to be done by professional traders and large market participants such as FIIs and institutional funds. On the other hand, option buying is usually done by small market participants like you and me who are retail traders. Therefore, when looking at an option chain, we always think from the writer's perspective and not from the holder's or buyer's perspective. In fact, this is another reason why it is vital to track the option chain and master reading it. As most of the option writing is done by professionals and large market participants, a changing option chain structure can give crucial clues about the upcoming move in the price of the underlying. Now, with that in mind, let us talk about the practical uses of an option chain. First of all, you can make use of an option chain to identify key areas of support and resistances. See, support and resistances are not always about marking lines on the chart. It does not need to be visual always. Sometimes analyzing numbers is more than enough. Take a look at this nifty option chain and tell me where most of the open interest positioning is. In this case, we can see that for call contracts, maximum option writing is at 25,000 strike, followed by 26,000 and 25,500 strike. This means that at these strikes, a lot of professionals have written call options, and therefore all these levels become quite crucial. Similarly, for puts, maximum option writing is at 24,000 strike, followed by 24,500 and 23,500 strikes. You can see how all these strikes are common psychological round number strikes. Can you also notice another pattern here? It is just that the large open interest is usually built at those strikes that are out of the money or OTM. Since out of the money calls have strikes that are placed above the underlying price, the strike price of OTM calls often act as resistances for the underlying price. Similarly, since out of the money puts have strikes that are placed below the underlying price, the strike price of OTM put options often act as support levels for the underlying price. So keep in mind that in an option chain, OTM call strikes can act as a resistance while OTM put strikes can act as a support. In the case of the previous Nifty example, 25,000, 26,000 and 25,500 call strikes are resistances while 24,000, 24,500 and 23,500 put strikes are support levels. In addition to this, as 25,000 call and 24,000 put have the maximum OI, these are the strongest resistances and supports respectively in this particular Nifty option series. What this means is that as of now, the market participants expect Nifty to move in a range of 24,000 to 25,000 for the current series. However, unlike visual support and resistance levels, which are usually fixed, the option chain support and resistances are dynamic and therefore they can change with time. Let's take this further. From the example, we know that the key supports to watch out for are 24,000, 24,500 and 23,500, whereas the key resistances to watch out for are 25,000, 25,500 and 26,000. Now, what will happen when one of these levels are breached? Let us consider the case of the immediate support level of 24,500 and the immediate resistance of 25,000. If Nifty goes below 24,500, Put writers who have a bullish bias could start unwinding or closing their positions as their profitability would start reducing. This unwinding of bullish positions could cause the underlying price or spot price of Nifty to decline lower towards the next support level of 24,000. Now, if this put unwinding is also accompanied by call writing at higher levels, this is an even more bearish signal. On the other hand, if Nifty moves above 25,000, call writers who have a bearish bias could start unwinding or closing their positions as their profitability would start getting affected. This unwinding of bearish positions could cause the underlying price or spot price to head higher towards the next resistance level of 25,500. Now, if this call unwinding is also accompanied by put writing at lower levels, then this is an even more bullish signal. I hope you have understood the play here. Anyways, let's now move on and understand how to use an option chain to identify potential shifts in the trend of an underlying. So, besides using option chain to identify areas of supports and resistances, it can also be used to find out the implications of shifts in the support and resistances as and when they occur. The direction in which support and resistances are moving tells a lot about the overall direction of the underlying instrument. To do this, you must closely monitor the changes in the open interest for both calls and puts. Keep in mind that the entire option chain must be monitored for such OI changes and not just the options that are OTM. Let's say if both call and put option writers are reducing their positions in the lower price strikes and they are increasing their positions in the higher price strikes, it means supports and resistances are both shifting higher. This gives a clear indication that the trend of the underlying is strengthening. On the other hand, if the call and put option writers are reducing their positioning in the higher price strikes and they are increasing their positioning in the lower price strikes, then it means the supports and resistances are both shifting lower. This gives an indication that the trend of the underlying is weakening. So in essence, supports and resistances both shifting higher denotes a bullish sentiment, whereas supports and resistances both shifting lower signals bearish trend. On the flip sides, supports shifting higher and resistances shifting lower or vice versa indicates indecisiveness about the trend of the underlying. I hope you get my point. In fact, it is quite simple, right? And finally, we can use the option chain to monitor and interpret what changes in price and changes in OI imply. Early in this video, I showed you a table displaying the relationship between price and OI. Let us take a look at this table again. In fact, I have shortened the inference section. You can see terms like long buildup or fresh longs, short buildup or fresh shorts, short covering, long unwinding or long liquidation, etc. Now, what does these terms mean? Meanwhile, let me show you another table that displays the implications of creating fresh longs and short positions, as well as closing out existing long and short positions for both call and put options. Now, this will give you an idea about the market sentiment. Using these two tables, let us do some analysis. So, if the price is rising and open interest is also rising, it means the market sentiment is strongly bullish. This signals a long buildup, or it indicates that fresh long positions are created. In other words, it means that the new contracts that are being added are dominated by bulls, and that is the reason why prices rise with every new contract addition. A long buildup on the call option depicts that market participants are ready for bullish action on the underlying, whereas creation of fresh longs on the put side depicts that market participants are ready for a bearish price action on the underlying instrument. So for call side, a long buildup is viewed as a positive event, while for a put side, it is viewed as a negative event. Now, if the price is rising, but open interest is falling, it means the market sentiment is weakly bullish, indicating a short covering. If prices are rising, but open interest is falling, it means that the rise in the price is actually due to short covering and not really because of the bullishness or new long positions being created. To understand this logic, you must ask an important question. Why is the open interest falling? The simple answer is that OI is falling because the existing positions are being squared off, and therefore the number of open contracts in the market is reducing. But since the price is also rising with it, it means that short positions are actually being squared off in this transaction. Now, how are short positions squared off in the market? It is simple. You square off a short position by buying back. This explains the reason why prices are rising. So, prices are not rising because of a long build-up or because of new long positions being created. Instead, it is rising because short positions are being squared off. Thus, price rising and OI falling cannot be considered strongly bullish, but it is considered weakly bullish. So, for the unaware traders, it can serve as a trap, forcing them into thinking that new long positions are being created. But this is not actually true. Now, short covering on the call side can signify that the call writers are squaring off their position by buying back, which could result in weakening of the resistance, which is actually a good sign for those traders who are expecting a breakout in the underlying instrument. On the contrary, short covering on the put side signifies that put writers are leaving their position by buying back, which could result in weakening of the support level, which is actually a bad sign for the underlying instrument, but a good sign for the breakout players. So in short, for a call side, short covering is a positive event, while for the put side, it is a negative event. The next scenario happens when prices are falling, but the open interest is rising. In this case, the market scenario is said to be strongly bearish. If the prices are falling and the open interest is rising, it straightaway means that shorts are dominating the longs. And since the open interest is rising, it means that new contracts are being added. But because the prices are falling, it means that the new contracts which are being added are dominated by fresh short positions and not really by long positions. Hence, it is a strong bearish signal. So, a short build-up on the call side depicts that market participants are writing fresh calls on a particular strike price, and that would act as an immediate resistance for the current price move. On the other hand, a short build-up on the put side depicts that the market participants are writing puts on a particular strike price, and it would act as an immediate support for the current scenario. So for the call side, short build-up is viewed as a negative event, while for the put side, it is viewed as a positive event. The final scenario happens when prices are falling and open interest is also falling. This indicates that the market sentiment is weakly bearish. If price is falling and open interest is falling along with it, it means that the fall in price is due to long liquidation. It is also called long unwinding. The important question to ask here is, why is the open interest falling? The real reason why OI is falling is because existing positions are being squared off and the number of open contracts in the market are reducing. But since price is also falling with it, it means that either the existing long positions are being squared off or fresh short positions are being created. Many of you will have this doubt. How will the existing long positions be squared off? To put it simply, long positions are squared off by selling. This is exactly the reason why prices are falling in this case. The prices are not falling because of the new short positions being created, but because existing long positions are being squared off more, also resulting in the open interest falling. Thus, it cannot be considered as a strongly bearish scenario. Instead, it is a weakly bearish scenario. This is one of the reasons why it can serve as a trap for those unaware traders, forcing them to think that new short positions are being created, which is actually untrue. So, in conclusion, long unwinding on the call side depicts that the market participants are selling off their call options because they no longer believe the underlying asset will rise to the level they previously anticipated, or they may be taking profits due to a perceived peak in the market. This selling pressure can lead to a decrease in the price of the call options. On the flip side, Long liquidation on the put side depicts that the traders are less concerned about a downturn in the underlying asset. They might believe that the market has stabilized or is expected to improve, reducing the necessity to hold options that benefit from a decline. So the prices of put options may decrease as a result of the selling pressure. So for the call side, long unwinding is viewed as a negative event, while for the put side, it is viewed as a positive event. Now, finding the market inference by analyzing all this data on a regular basis can become time consuming, cumbersome, and tiring. Both NSE website and sensible option chains don't provide this analysis, but there is always a way around. You can use the option chain provided by Fire's broker. If you don't know, Fires provide one of the best trading terminals for both intraday and derivatives trading. It has a lot of useful features, out of which trading from charts is my personal favorite. There is no account opening fees or maintenance charges. I have attached the link to open an account if you're interested. Don't worry if you don't want to open an account, you could use the option chain provided by Nifty Trader website. The site offers a lot of other data as well. You can find the link in the description. Now moving on, here I have provided two tables that you can use to understand the effect of price and OI relationship with respect to call and put options respectively. I urge you to pause the video or take a screenshot and read it. We have already discussed this, so I won't talk about it again. And finally, let us combine both calls and puts together and understand the market sentiment. If a call writer is adding fresh positions while a put writer is exiting their existing position, it implies a bearish sentiment in the underlying. For the short term, it suggests that the resistance is strengthening while the support is weakening. Secondly, if the put buyers are increasing fresh positions and the call buyers are exiting or squaring off their existing positions, then it indicates a bearish sentiment in the underlying. Now, if the call writer is exiting his existing positions, but the put writer is adding more fresh positions, it implies a bullish sentiment in the underlying. For the short term, it suggests that the support level is strengthening while the resistance is weakening. And finally, if the call buyers are adding new positions while the put buyers are decreasing or exiting their existing positions, then also it indicates a bullish sentiment in the underlying. So as we can see, activity taking place in the option chain can provide clues as to what might happen in the underlying asset in the very short term. Once the Indian market opens, you can wait for some time, say 15 minutes to half an hour, to allow the markets to stabilize and digest the overnight developments. How the option structure of the underlying develops during this period can often provide clues as to what lies ahead in the session. All these analyses can be done similarly on both index and stock options. There are no changes in the inferences. So go back to your charts and option chains and do your analysis. So this is a very important episode that sets the tune. We have seen how option chain can be used to get a holistic picture of the underlying asset that is being monitored. However, I would like to break it to you that option chain is not a substitute for other forms of analysis, such as price action, SMC, and technical analysis. Instead, it must be used to complement the other forms of analysis, especially when building option positions. Taking trading decisions only based on observations made from the option chain data can sometimes be quite risky. For short-term trading, you can complement option chain analysis and other form of technical analysis to carry out informed trading decisions. While technical or price action analysis will help you identify the trend and enable you to time the market, option chain analysis will inform you where the maximum activity is taking place and how the overall structure of the underlying is building up. Another important thing to keep in mind is that option chain analysis should be done only on stocks and indices that are liquid. Performing option chain analysis on assets that are illiquid will often give incorrect information and it will be prone to errors. In the case of NSE, instruments that are extremely liquid for option trading are indices like Nifty, Bank Nifty, Fin Nifty, BankX, etc. and a few of the top stocks of future segment that are also part of the Nifty 50 index. Examples of liquid stock options include Reliance Industries, TCS, HDFC Bank, SBI, ICICI Bank, Infosys, Maruti, Hero Motors, Tata Steel, Tata Motors, Hindustan Unilever, Larsen and Toubro, etc. Some of these stocks might get banned from the derivative segment at some times, so check for its availability before trading. Having said that, before trading stock options, I would suggest you look at the individual option chain to find out whether or not these options are liquid at any given point in time. I strongly believe this is the most comprehensive video ever on option chain OI analysis. I doubt if paid courses would go this deep. If you think this video is a game changer, give us a thumbs up. Comment down if you have any doubts or queries. Share this video with all your friends and fellow traders. Also consider subscribing to our channel and enable the bell icon to get notifications when new episodes are uploaded. Thank you for your valuable support. I will see you guys in the next episode. Till then, bye.